this needs to be properly timed for you. Why do I say so? Because if you are viewing this and the market is still rallying, you kind of think it's unbelievable. Very often in terms of investing, if you are way too early, it's indistinguishable from being wrong. You know, legendary investor Jeremy Grantham has mentioned that he believes stock markets is poised to decline by another 20% this year in 2023. And in the worst case scenario, it could fall by 50%. You know Jeremy, he's a perma bear, which means he's forever bearish. It's not unusual for him to say a doomsday prediction like this. So today I'll be sharing with you which parts of his comment I agree with, as well as some lessons that we can see from history. So if you think I have the goods, smash the like button early and let's roll in the intro video. Hi guys, welcome back. Let's start by reviewing some charts. Take note again, this is mid of February 2023. Everything seems to be rallying right now. It's hard to make a contrarian call. S&P 500 has rallied 6.67%, Nasdaq 13.48%. Google, who is the one who seems to be struggling the most, has also appreciated 5.45%. Now the problem of looking at short-term charts is that it creates recency biases. Then what about for Singapore's side? Keppel DC REIT could be amongst the best performers of REITs year to date 11+%. However, banks seem to be struggling. I also like to highlight that in the near term, there seems to be a fun, peculiar trend of Singapore banks being inversely related to Nasdaq. When Nasdaq goes up, banks go down. When banks go up, Nasdaq goes down, so on and so forth. All this could be related to interest rate speculation. I've also seen 4 comments that feel that the market has taken off already. This is actually by Ben. So as always, I appreciate all the comments they leave below. And the concern is about missing out on this current bull run. Right now on the CNN Fear and Greed Index, you realize that greed is back now in the market. Now you know this pendulum of market mood. One moment it's extreme fear, one moment it's greed. And then after this greed moment, it's very likely if the pendulum will swing back to fear. So talking about fear, if indeed S&P 500 drops by a 50% worst case scenario, it could mean the S&P 500 would be around the level of 2,000 points only. Quite extreme, correct? Unbelievable, correct? My view is that this crash is a bit more like the tech bubble burst in 2000. That's something I mentioned in the previous video. It's not too much like the global financial crisis we experienced in 2008. That's why I'm only inclined to believe that the markets could drop by 20% on the S&P 500, which could leave it to a 3,200 level. You may be thinking, how can that be? Why so? What are the negative sentiments that could really restrike back fear into the market? Markets after all had dropped for the entire of 2022. And you know, market news seems to be suggesting that Fed might slow down on interest rate hikes, correct? And as always, I'd like to pose a question to you. Fed news, is it noise or not? You have to decide for yourself. But I'll be presenting 2 angles for you to think through, especially if you want a contrarian point of view. The first regards price charts. You see that right now everything looks good, correct? Moving averages seem to be trending up, correct? S&P 500 seems to be closing in to 4,100 points. The 50-day moving average has as a consequence been pulled upwards and looks to be cutting through the 200 downward moving average. This looks like good news, and if we compare to the dot-com crash, you realize that the 50-day moving average couldn't even cut past the 200 and then the markets fell back down again. That's in February 2002. 15 months into the bear market. But I've actually found an alternative to compare against to show you that the 50-day moving average cutting through the 200 is just not conclusive. And this chart actually comes from Microsoft. Why should we actually look at Microsoft? Microsoft, of course, is a bellwether right now in S&P 500, being the second largest company listed in US. But did you know that back in the dot-com crash, Microsoft was once the biggest company in the world, which means it was also a bellwether back in that era. You also see that tech companies and networking companies dominated the landscape back then. Cisco, Intel, and TNT, Lucent Technologies, and Nokia were also in that top 10 list. Later I'll be sharing with you post-bubble who is still surviving on that chart. So if you're keen, continue watching on. I'll be showing you an impact of the crash. But the focal point again is Microsoft. If you were to see the charts, Microsoft's share price crashed after the dot-com bubble burst, correct? But it rallied strongly in March 2001. The 50-day moving average actually cut through the 200-day moving average, and all the worst seemed to be over. You can guess that investors back then would be thinking, hey, I'm investing in great companies, correct? They will come back. Its share price looked to be very resilient, going down and bouncing up again. This time round, the 200-day moving average even started to tilt back upwards, and all the technical analysis experts would have been suggesting that the worst is definitely over. Let's take a pause here in end 2001, because if that were to play through this time round again, S&P 500 might actually show some resilience. But what do we know? If we were to fast forward a bit more, you'll see that a 20% decline is definitely conceivable. What could have gotten prices back down again? Negative news? Let's look at what negative news Microsoft is actually publishing right now. It's seeing possibly slower sales growth for the next 6 years. This could spook analysts. Everybody could be rewriting target prices downwards, and that's actually how markets actually vote for prices. And before we conclude too quickly that, hey, maybe I'm a long-term investor, take note again, if you were to invest back in March 2001, you would take 11 long years before the price of Microsoft finally breaks out of that $30+. And do know again, as compared to investors of, for example, Citigroup, this underperformance is very painful. Take note again how hard it is to be a long-term investor. Just now I mentioned this chart over here that suggests that post-bubble, there was no market cap dominance by any particular industry. Right now, tech players dominate S&P 500. Big four include Apple, Microsoft, Google, and Amazon. But in a post-bubble, you will realize that there's certain reshuffling. Microsoft has dropped to number 3. You'll see Pfizer at number 4, where it was previously not on the top 10 list. You also see Citigroup at number 5, AIG at number 8, and also number 10, Bank of America. It seems like banks have become new kings. Citigroup versus Microsoft share price looks like this. And the outperformance of Citigroup actually rallied back to a share price that it experienced back in 2000. The outperformance over Microsoft is that staggering. But we kind of know what happened in 2008, correct? Everything that starts to inflate sees a bubble being burst at some point of time also. Let's move on to the second point that you need to consider as to why markets could indeed correct back downwards by 20%. This over here is S&P 500 10-year PE ratio versus its historic average. This has another name called the Shiller ratio. And do note again, this is as of 20th January 2023, which already factors in a lot of the market decline in the previous year. You realize that this current ratio measures S&P 500 at 28.6 times, which is 42% above the market average of 19.6 times. This suggests that the market is overvalued. And if we were to look at the current price earnings ratio, you realize that S&P 500 as of 26 January 2023 at a point of 40,060 points is at a P ratio of 21 times, which is easily 20% above the mean and median mark. So 20% lower towards 3,200, I actually would think that is more likely than not. But hey, that's again my point of view. I just don't see the panic yet in S&P 500. And as Jim Rogers has said it well, the last leg of a bear market always ends in panic. But if you are keen to buy S&P 500 for long term, I have this word of caution and this suggestion for you. Don't go punting for the bottom. In bear markets, our patience is tested. And this FOMO feeling only exists when you haven't bought. You see that the thing has actually rebounded from its bottom. You'll be anchoring your expectations at that previous price that you missed. It also doesn't help to hear reports like this from Wells Fargo stating that the bear market is over. So there's that FOMO to battle against. And once you have pressed the click button and you have started buying, you finally realize that fear firsthand when prices move below your purchasing price and you start to see paper losses. And the next market negative news could jolly well convince you to cut your losses. I don't know if you agree or not, leave in the comment section. As always, if this has benefited you, smash a like, smash a subscribe. And last but not least, join our members channel. There are 3 tiers, and this is a special shout out to all the Let's Make a Difference tier, whereby there's access to private videos as well as joining my donation towards NTU. And this is what I again would suggest. Dollar cost average. In a bear market, don't go punting for bottom. It is very difficult. Dollar cost average and take out the emotion. And I actually did a simulation for you already. If on 1st of March 2001, you set a dollar cost average of $1,000 per month, you would have still taken 3 years to break even. 9.87% gain to be exact. But hey, that's still better than if you had bought lump sum. The lump sum S&P 500 purchase on 1st of March 2001 would still be negative 8.92% because the market continued to go down further. That's a much better approach to accumulating. I've actually done that for myself, investing in China equities. You can actually check out this previous tutorial whereby I've actually painstakingly built a 50-week program and it is now yielding results. A lot of my positions were bought automatically when it was all gloom and doom. And if you think a bit clearer, that is actually how to succeed on the markets. Look at the tutorial. I'll be releasing another update on China equities and I hope to see you then too. Thank you as always for watching and I'll see you next one. Take care and goodbye.